Good evening, ladies and gentlemen. On behalf of Indiamart Intermesh Limited, I welcome you all to the company's Q1 FY24 earnings webinar. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Joining us today from the management side, we have Mr. Dinesh Agarwal, Chief Executive Officer, Mr. Brijesh Agarwal, Whole-Time Director, Mr. Prateek Chandra, Chief Financial Officer. Before we begin, I would like to remind you that some of the statements made in today's conference call may be forward-looking in nature and may involve risk and uncertainties. Kindly refer slide number 3 of the earnings presentation for the detailed disclaimer. Now, I would like to hand over to the call to Mr. Dinesh Agarwal for his opening remarks. Thank you, and over to you, Dinesh.
Thank you, Shakil. Good evening, everybody, and welcome to the Indiamart FY24 earnings webinar. Sorry for the slight delay in starting. I hope you guys can hear us clearly. We have already circulated our earnings presentation, which is available on our website as well as on the stock exchange's website. I'm sure you would have gone through the presentation, and I would be happy to take any questions after you. I'm pleased to report that Indiamart has started this financial year on a positive note with about 26% year-on-year growth in collections to 321 crores and 25% growth in deferred revenue to 1202 crores. Revenue from operations also grew by 26% to 282 crores. Total traffic and resulting unique business inquiries on the platform remained stable. People front, we added about 238 new employees across sales, service, product, and technology in this quarter. We will continue to make these investments in strengthening our organization to leverage the growth of it. In this quarter, we decided to withdraw discount in our entry-level packages and restored the prices to the pre-COVID level. Due to this change in the price, our net customer addition of 5K was lower than our guidance. It would take us at least one more quarter to normalize the impact of this price change. We should get back to our guidance of 7 to 8K net customer addition per quarter from Q3 onwards. As you may have noticed, we have expanded our board with the addition of Mr. Akash Chaudhary. Akash is an entrepreneur, co-founder of the Akash Educational Services Limited. He successfully scaled up Akash Institute before selling the business to the Byju's. We look forward to working with him closely and benefit from his experience. Before I conclude, I would like to say that we have reviewed our capital needs in this quarter and approved the distribution of surplus funds of rupees 500 crore to the shareholders by way of buyback. This buyback remains subject to the approval of shareholders. Overall, we stay confident of growth on all important metrics as we see improving macroeconomic environment, increased adoption of internet by businesses. Now I will hand over the call to Brijesh for update on Busy Infotech. Thank you, and over to you, Brijesh.
Hi, good evening, everyone. Busy has delivered a billing of 23 crores in the Q1. This represents a YOY growth of about 94%. The revenue from operations have grown by about 26% to 13.5 crores. And the deferred revenue has grown by 57% to 36 crores. The EBITDA for the quarter stood at 3.1 crores, which is a margin of 23%. And the net profit for the quarter was 3.6 crores. We generated positive cash flows of 11.1 crores during this quarter. And we've also sold about 9,000 new licenses in Q1 itself. Now the total count is up to 340,000 licenses at the end of June 23. The overall performance has been in line with our expectations, and we are focused on increasing our growth rate as we had suggested last time. And hopefully we are on track to achieve that. With this, I will hand over the call to Prateek so that we can discuss about the financial performance.
Good evening, everyone. I will take you through the financial performance for the quarter ending June 2023. Consolidated collection from customers and revenue from operations grew by 26% each to 321 crores and 282 crores respectively. Deferred revenue for the quarter stood at 1,202 crores, an increase of 25% on a YOY basis. Indiamart standalone collection from customers for the quarter were at rupees 298 crores, and revenue from operations stood at rupees 268 crores, registering year-on-year growth of 23% and 25% respectively. Our growth in revenue was primarily driven by 16% increase in paying subscription suppliers and 8% improvement in ARPU due to higher monetization. Deferred revenue were at rupees 1,165 crores, representing a YOY growth of 25%. Indiamart standalone EBITDA stood at rupees 76 crores, representing a growth of 27% YOY and margin of 28%. Consolidated EBITDA was at rupees 77 crores, representing a margin of 27%. Our consolidated net profit grew substantially to rupees 83 crores as compared to Q1 last year, primarily due to changes in fair value gains on treasury investments. Consolidated cash flow from operations was rupees 91 crores and cash and treasury balance stood at rupees 2,394 crores as at the end of this quarter. The buyback proposal as approved by the board is for buyback up to 12.5 lakh shares at price of rupees 4,000 per share for an amount not exceeding rupees 500 crores. This is proposed to be done via tender offer route with pro rata participations from the promoters and the promoter group. As this accounts to roughly around 24% of the share capital and reserves and approximately 2% of total paid up equity shares, the proposal remains subject to the approval from the shareholders. Thank you very much. We are now ready to take on the questions.
We will now begin the Q&A session. If you wish to ask a question to the panelists, kindly raise your hand and allow camera and microphone access. Alternatively, you may type your question in the chat menu and we will revert on it. Please restrict to 2 questions so that we may be able to address questions from all the participants. We will wait for a couple of seconds while the question queue assembles.
First question is from the line of Manish Gupta from Solidarity Capital. Hi Manish, please go ahead with your question. Manish, you're on mute.
Thank you for the opportunity. I have 2 questions. First question is for Pradeep. That if you look at your revenue to collections ratio, FY22 and in FY23, it is about 80%. Is my understanding correct that all your selling cost is written off in the same year? Because it doesn't show there's nothing in prepaid expenses in selling cost. And therefore, if one will follow the matching principle of selling cost apportioned to revenue proportionately, under IFRS, your reported margins will expand by 4 or 5%.
So, Manish, to answer your question, the financials what we have reported is as per the Ind AS, which is pretty much in line with the IFRS. So what it talks about is that essentially any cost that you incur needs to be recognized upfront. Since we pay upfront for the customer acquisition, which is primarily a selling and distribution cost, we recognize the entire cost upfront, and depending upon the period of the contract, the revenue gets recognized. So your point is correct that from looking at a pure matching perspective, of course, the costs are taken upfront while revenues are taken over a period of contract.
Not all the costs, because there are servicing costs also, and the servicing cost would be coming commensurate to the revenue recognition.
Yeah, my point was only on selling cost, which is about 20% of revenue. So to the extent that all the selling costs are being recognized upfront, the true profitability is actually higher than reported profitability, right?
That we can calculate by way of the collections from customers. So there is a slide on collections from customer and collection margin.
My second question was that our top 10% of customers are approximately 50% of revenue. Is it, and you have such extensive disclosures, is it possible to add a disclosure on gross additions and net additions of your top 10% customers?
The top 10% customer is nothing, there's not direct inward or outward from there. It is just the total number of customers, which is 208,000, and top 10% becomes 20,800 customers. So the revenue recognized from those top 10% customer is that is 46% in this particular point.
Yeah, my question is that. Yeah, my question is it possible to report attrition in that bucket separately?
So that I anyway talk about, because when you say top 10% customer, and I have said this multiple times, that our platinum bucket itself is greater than top 10%. Earlier it used to be almost equal to the top 10%. So all of those customers are in the platinum subscription, and in the platinum subscription, our churn rates are less than 1% per month.
Okay, and my last question is that will we see Busy in a cloud format at some point in time?
So there are two things that we are doing with Busy. One is to take the Busy desktop version and make that available on cloud. So essentially, it is a desktop version, but it's the machine which is hosted on cloud, which you can access using a remote desktop facility from anywhere. That is something which we are going to launch in the near future. The pure, let's say, Busy as a SaaS version, I think that is multiple years away, because what has been created in the last 25 years at Busy, it will take many more years before we could build it in a SaaS version.
Okay, thank you.
One more addition to this, we've already introduced a mobile app that connects with the Busy desktop, which means the data that is available to users on the Busy desktop is synced on the cloud, which can be viewed using a mobile app. One can also now create orders, invoices, receipts through the mobile app, which sync back into the Busy desktop. So that's another product that we've launched just a couple of quarters back.
Okay, thank you.
Thanks, Manish. Next question is from the line of Ms. Ruchi Mukhija from Elara Securities. Hi, Ruchi, please go ahead with your question.
Sorry, Ruchi, we can't hear you.
Hi, thank you for the opportunity. I have two questions. Firstly, we've seen for Indiamart platform, the traffic has been static for some quarter. Even the unique inquiries has been, I would say, range bound in the recent quarter. You're saying that to reach the guidance of about 6,000 to 7,000 quarterly paying vendor addition, we would take some more time. So in that context, the pricing increase in your junior most category, that seems that it carries some risk. So here just want to understand what is the reasoning behind taking this pricing increase at this point of time.
So we were at 3,000 rupees per month or 30,000 rupees per year pricing we introduced in September or November 2018. And we continued doing that until 2020. And then 2020, we hit the COVID. And a lot of micro and small enterprises were facing challenges on the cash flows and on the. So that's when we gave the discount to from 3,000 rupees to 2,500 rupees. So if you really see what we have restored back is 2018 September, October, November prices. So it is not really increasing any prices at the bottom of the pyramid. It's just the going back to the old price, which was established. We carried that price for almost 1.5 years.
And could you talk about was it effective throughout the quarter, or it was taken in between the
Exactly in the middle of the quarter.
And was there any change in the conversion rate after the pricing increase, or we saw almost a similar run rate even after the pricing increase?
No, as I said, we had productivity issues, and that we have seen every time there is a change in the price. It takes 3 months to 4 months for productivity to get back to the previous level. And we have only completed 2 months so far. I think in a couple of more weeks, the productivity should get back to the previous level.
Understood. Now, second aspect I wanted clarity was on the buyback. It's a welcome announcement. Here, just wanted to get more clarity. We've been announcing dividends at several, I would say, frequency. We've done buyback even last year. So you've been rewarding or distributing cash flow to the shareholder. But is there some thought process where we put commitment and quantify how much on regular basis would we return capital to the shareholder?
Ruchi, thanks for your question. So as a company, if you see our track record, we've been using both dividend distribution and buyback for distributing these surplus funds. This buyback was primarily decided because when we reviewed the funds, we had almost 2,400 crores of cash balance as of now. And if you see in the last few years, we've been generating anywhere between 500 to 600 crores of cash every year, including the income from treasury and the cash flow from operations. So looking at the cash flow generation as well as our own growth capital needs and the safety cash requirements of the business, we thought that this 500 crores was the surplus funds which needed to be distributed to the shareholders, and accordingly we proposed a buyback of 500 crores.
Understood. That's helpful. Thank you and all the best.
Thanks, Ruchi. Next in queue is Anmol Garg from DAM Capital. Hi, Anmol. Please go ahead with your questions.
Yeah, hi. I hope I am audible.
Yes.
Yes, Anmol.
Yeah, hi. Firstly, congratulations on a good buyback announcement. I had a couple of questions. Firstly, if I look at our paid supplier as a conversion factor, then we are at around 2.7% of the total supplier. Now, historically, this has been in the range of 2.3 to 2.5 odd percent. Now, given that the paid supplier growth that we are seeing for a longer term, which is 7,000 to 8,000 kind of paid supplier addition, and given that our total supplier additions has been a little bit softer than that in terms of the growth rate. So we will surpass 3% kind of number on the conversion factor at some time. So do you think that this is a kind of which is sustainable in terms of the if we talk on the overall conversion factor? And what are the factors that or what are the things that we are doing to add on onto the new paid suppliers?
Worldwide, in the classified space, the premium classified space, anywhere between 2-3% to 4-5% paying subscriber base is very common and very normal. If you see if you see from our own angle, total GST supplier base is about 13-14 million today in the country, and out of that we probably have only got 20-25% on our portal. Rest is non-GST suppliers out of the 75 lakh that we have. We do all kinds of things to make suppliers register with our portal. Many buyers, many people who come as a buyer first, they are given a Sell on IndiaMart button from where they register, which is available on mobile app as well as our desktop both. Apart from that, we have a field sales force of about 1,500 people of our own and 150 channel partners in different cities. They also have field sales force, and these people have a IndiaMart mobile ERP system on their app, where they go and collect this information from the various wholesale markets. So that is another source. And third, we regularly visit all the trade fairs and collect any directories that are there, and then do email marketing and telemarketing to them. We also run a freelancer program, which basically helps on the supplier register. Many suppliers also call us on our helpline number 9696969696. So from there also we get supplier registration. We have been getting about 0.1 million supplier every quarter, free of cost, and about 6,000-7,000 supplier per quarter or 8,000 per quarter. So that is 1 lakh per 5,000. So that is fine, I think.
Sure. Thanks for the detailed answer. Another thing that I wanted to understand is that this year we have added some 280 odd employees. Now, last time we indicated that for addition of 7,000 to 8,000 kind of paid supplier, we need to add some 120 to 130 employees to service them. Now the paid supplier addition has been a bit lower this quarter. Despite that, the total addition in the employees has been higher. So if you can indicate, do you see that the paid supplier additions maybe in the second half of the year will be much higher than 7,000 to 8,000?
It's more of a planning and deployment and execution. And since the price has been increased in the middle of the quarter, and we believe that is the right thing to do. And this productivity loss is a temporary 2-3 months loss, and that might be the reason. So we will definitely like to get back to our 7,000 to 8,000 number sometimes later this year, for sure. Whereas the hiring of the numbers are concerned, people are to be hired and trained and deployed on the field, especially June, July is the time when a lot of campus hiring concludes after the examination. So, plus minus 100 here and there will continue to happen, I think.
Sure. And lastly, from my end, just wanted to have understanding on the margin trajectory. How should we look at the margins, particularly for FY24 and beyond as well?
By 24, I've been saying that the target is to see if we can reach 30%. Historically, pre-COVID, our margin was 28%, which has increased from 12% to 16% to 28%. So now, on a full year basis, if we can reach 28%, and maybe towards the end of the year, if we can reach on a quarterly basis towards 30%, that should be our target. Going beyond, I think, as I have guided earlier, also these businesses typically operate in a 25 to 35% margin. So I think we are at the middle of that, and we would like to stay that way to maintain our growth. And if you see the operating leverage, that operating leverage is was slowly playing out, but then we had a cost during the we have saved the cost during the COVID, and then there is a sudden run up of the cost because of the salaries in the market, and we backfill the people. So I think we are fine at 30%. Let's see, once we stabilize at 30%, how do we go from there?
Sure, Dinesh. Thanks for the answers. That's it from mine.
Thanks, Anmol. Next in queue is Mr. Rahul Jain from Dollard Capital. Hi, Rahul, please go ahead with your question.
Yeah, hi, hope I'm audible.
Yes, please.
Yeah, thanks for the opportunity. Firstly, just want to understand your experience. You shared a little bit about that, but it would be great if you could spend some more time on that. What is the general experience for you for this kind of a price hike impact? Is it on the new addition run rate basis, and also increase on the existing monthly plans on the silver basis? So if you could tell in both the aspect that what kind of impact you have observed, and what is your past experience and your understanding how and when it should normalize back.
We don't increase prices of the existing product. I mean, existing means existing customers. Existing customers will pay higher price when it comes up for next upgrade or next year renewal. So, for example, on a monthly scheme, if you have taken 2,500, as long as you don't churn, you will continue to pay 2,500. There is no increase on that. It is only the new customer who is coming in at 3,000 rupees. So it is very incremental impact on the overall ARPU to begin with. Yes, over the year and a half or so, it starts to take overall impact, because if the entry level price is higher, then upsell price is also higher, renewal price is also higher. So that is how we see it. So the good part is in our business that any price hike that is taken, neither does it reflect immediately in the ARPU or any. So if you see, there is a consistent growth in the average revenue per customer year on year, despite the fact that we have actually reduced the price from 3,000 to 2,500, because some other package and some other maybe gold or platinum, that's where we compensated. So it's a mix of so many different packages and different customer vintage that is visible in the average revenue per customer. So in the past also we have seen that it takes typically 2 to 3 months or maximum to finally get back to the previous product sales productivity. And once it stabilizes, then I think it builds up the base for both. It helps us reduce the churn from 2,500 subscribers, and it also help us increase the further upsell price from say 40,000 to 45,000.
Right. Right. Yeah, thanks for that color. Just one more question regarding the sales cost, which has also gone up 6% QOQ despite weak net addition. Is it that we have also increased our channel partner commission along the lines of price hike?
Not really, because the cost will go up probably because the productivity has gone lower. That is why you might be seeing it. I don't think there is any difference which has been done.
But if the channel partner are monetized or commercialized based on the conversion, is it higher because our gross addition would be much higher and the net is lower, so we might have paid for a higher addition, but the net impact was lower. Is that the understanding right?
I don't have that upfront.
You want me to repeat the question, sir?
No, I don't have that answer upfront. Maybe you can send us an email and then we can give you that answer. Because I don't
Sure.
think it is 100% not variable, because we do provide assistance, a minimum guarantee for channel partners, and then there is a variable component.
So so Anmol, I mean, half of our cost is essentially not completely variable, because there we pay on a per person basis. On half of the cost, you can say, where we pay, which is a completely channel partner on a per hosting basis. There also, we do provide an early support to the channel partners depending upon their own vintage with us. So therefore, it could be a mix of the things. We will look into it and then we can come back to you with the detailed answer there.
Sure. And just one clarification to your earlier comment where you said the upsell plan prices are also revised up. Is that what you were trying to say?
No, once we stabilize this, the upsell prices are also upwardly revised because we have a stair-based upsell approach.
Right. So you're saying you would do it after some time, or it is already implied but would be relevant as these people progress into that plan?
As these people progress.
So the effective date would be what?
No, it is not as effective date, because if you come in at 3,000 rupees, your annualized cost becomes 30,000 rupees. So your multi-year, if you take a 3-year package, it becomes 60,000 rupees. If you came in at 2,500 rupees, your annualized cost is at 25,000 rupees.
Right.
So that's like this.
Yeah. So essentially what you're saying is that if you take a multi-year plan, the longer tenure discount also would have, that revision would have happened even if I take a 2-3 year plan versus what I would have taken a 2-3 year plan earlier.
Yes.
Yeah. Understood. And is there a way to understand what could be the addition to the EBITDA or revenue on a like-for-like basis because of this pricing impact on annual basis?
It will be very little, because to begin with, out of the 208,000 customers, we would be adding maybe 2,000 customers per month on this new pricing. So imagine it is, and that is going to come at, so 1% new customer is going to come at 20% higher. So it's a 0.2% addition to the revenue, to the additional collection per month.
Right. Okay, I'll take this offline. Thank you, and I'll join back the queue.
Thank you, Rahul. Next question is from the line of Mr. Abhishek Banerjee from ICICI Security. Hi, Abhishek. Please go ahead with your question.
Hi, sir. Thanks for your time. Just quickly, on the price increases that you have taken, what is now the differential between the silver and the gold plan vis-a-vis what it used to be earlier?
The gold plan, again, there are HCL gold and there is a website gold. So maximizer is about 60,000 rupees per year, and HCL is about 40,000 and 60,000 for 40,000 rupees per year. And for multi-year, there are various discounts available. So the price list is available on our website. If you go to the corporate.indiamart.com, the prices for various services are written there.
No, sir. Got it. So my question was with regards to, do you think this will lead to your customers kind of upgrading to a gold plan because you are bringing the pricing differential lower? Is that something that you are hoping for?
No, I think as I explained earlier to Rahul Jain's answer, it has a cascading effect on your customers over a period of time, and older customers coming up for renewal. So for them, the pricing is passed on even more slowly because we cannot, somebody paid last year, say 27,000, we cannot suddenly start 30,000. So we will probably take it up in 2 renewals, that price increase. So typically, this price increase takes effect on the entire, suppose it is 3,000 rupees to increase annually, it will come probably in 3 years' time.
Also, Abhishek, actually, this price increase is more of a restoration of an old price rather than increasing the price from the levels where it was. So, I mean, earlier also we were operating with the similar differential.
Got it. Got it. So also with regards to the guidance in terms of adding new subscribers, the 7,000 to 8,000 number, is it with regards to basically the full year, as in you want to say that you would add between 28 to 30,000 new subscribers for FY24? Is that what you're trying to say? Because my understanding was that quarterly number was in the range of 8 to 9,000.
Quarterly number was in the range of
8 to 9,000.
Yeah, it was 8 to 9,000. That we last time we had revised the guidelines to around 8,000, and now I'm saying that we will try and do 7 to 8,000. It is from 9,000 earlier we used to guide 8 to 9,000, which was correct for FY23, because in FY23 it was the first full year of our expansion. Now we have added, if you see, about 60,000 new customers in the last 18 months. And those 60,000 new customers, many of them are coming for the first time renewal. And first time renewal rates are much lower than second time renewal and then the third time renewal. So what happens is the churn base effect comes in. So that is why the addition rates have to we have to go on a growth path and then consolidate, go on a growth path and then consolidate. Because if we press the pedal heavily on the growth, the first year churn will not let you grow beyond a certain point. So you have to let the first year customer migrate to the second year and third year. And once that balancing happens, then you press the growth pedal.
Understood, sir. That is clear. But now, if I look at the margin guidance that you're giving, 28% for the full year. So I'm actually struggling to understand, given the kind of revenue growth that we are seeing. Also, you have earlier said that you will not need to hire too many new people. So my model tells me that the margin uplift should be higher, right? So I'm trying to understand, is it that, are you building in for more tech investment? Are you building in for, more investment into CAC you're going to do SEO. If you could give us some clarity on that, then we'll also understand why the margin uplift will not be as much as it should be. I mean, when the other expenses have kind of topped out.
So effectively, if you look at the margin lever, we have our cost is still trending at 72%, 73% quarter on quarter. And we continue to invest behind newer technologies also. The newer technologies is far more expensive. We continue to move towards the cloud again. Cloud is again far more expensive. So on an overall basis, the first year customer needs a lot more service effort. The upfront CAC also needs a lot more service effort. So that is why I'm little afraid of giving you a guidance above 30%, because the cost pressure is continuing in the last 18 months, whether it is salary cost pressure or whether it is technology cost pressure. I think, and it was completely different the first 18 months of the COVID and then last 18 months.
Understood, sir. That is helpful. And one last question from my side, if Brijesh sir can answer this. So, Busy, we are seeing a very, very strong ramp up, right? Where from here? So, last year, your objective was to kind of consolidate what you had acquired. Is this year going to be an all-out growth year? How are you looking at it?
The guidance that we had actually given earlier is that every single year that we spend at Busy, our aim would be to increase the growth rate that has been there traditionally. So even in this particular year, we want to increase the growth rate in itself. What you see in let's say Q1, is also a result of certain exceptional growth that we've seen in a couple of areas. But what we can go ahead and confidently say that as we start to push for our own geographical expansion, we should be able to achieve higher growth rates than what we've seen in FY23.
Got it. Thank you so much, sir. Congrats on a great set of results. We'll catch up with you later.
Thanks, Abhishek. Next question is from the line of Mr. Amit Chandra from HDFC Securities. Hi, Amit. Please go ahead with your question.
Yeah, hi. I'm audible?
Yes.
No, thanks for the opportunity, sir. So my simple question is, in terms of the growth that we're seeing in terms of the paid subscribers at an overall level, it's around 16 to 18%. But if I see the growth in terms of the various buckets, so in terms of platinum, gold, so how has been the growth there in terms of the absolute number of customers? So is it higher than the overall company level, or how is it trending? Because if I see the ARPUs, they're going up. So there is a migration from monthly to a gold to a platinum. So what is the parameters that will show us that there is migration going on? And also in terms of what percentage of the customers upgrade every year?
So if you see the top 1%, that is why we give this top 1%, top 10% numbers, right? Because we don't provide the exact silver monthly, silver annual, gold and platinum numbers, but we do provide top 1%, top 10%.
That is in line with the overall company, because every time if you do top 10, then the growth rates for all three buckets is this. For us it's the same. But internally, how has been that tracking? So that's what I want to understand in terms of absolute numbers.
We will discuss internally, and maybe we'll try to find one KPI which can help you decipher that.
So if
in general, if I want to give you the overall sense as of now, what is the mix? Currently, out of the 2 lakh customers, about 1/4 are on the silver monthly, about 3/4 on the rest of it. And similarly, if I look at the platinum and gold customers, they currently account for about 50% of the customer base. So I've given you all the 3 numbers.
okay, so and in terms of the upgrades, how many of the monthly paid suppliers who are there on the platform, say for like 6 months, they upgrade to an higher package? So what is that number? If you can give any number that you can share there.
So typically, about 2% of the customer of the total base. Typically, and that can range, from manager to manager, from industry to industry, from city to city, anywhere between 1% as low as 1%, as low as 3%. But on an overall basis, approximately 2% customer base, if I'm able to get to upgrade from a monthly to a annual or a trust, I think I would generally be happy.
Okay. And sir, in terms of the monthly additions or in terms of the paid subscriber addition that we're doing, is it all in the like monthly bucket, or is it we add some customers directly to gold, platinum as well? So
So we don't add much customers to the gold bucket, but in the between the silver, we add about 60% on the monthly and about 40% on the annual.
okay. And so lastly, on the price hikes that we have announced for the monthly subscribers, what is the price hike that we have taken ever in terms of gold, platinum in the past, and is there any plans to increase price there in gold, platinum?
That is clearly visible. If you see the top 10% customer revenue, I remember we started giving that number. It was in the range of 7 lakh rupees or so annually or quarterly about. So it has grown up almost by 30-40%. Yeah, I know. And the gold and top 10% customer used to contribute, 40% of the revenue. Now today they are contributing about 46% of the revenue on a grown revenue base. So the overall customer base as well as the ARPU. In fact, most of the ARPU gain would have come typically from the gold and platinum, because if you see from FY 2018, I have not increased any prices in the silver. I've only given that discount during the COVID, and now we are withdrawing that discount. So since September, October 2018, the silver monthly and silver annual prices are same.
Okay. And sir, the last question is on the margins. So obviously, we have seen some margin expansion, but if you can, throw some light in terms of what proportion of the cost will increase, in line with the, growth in terms of the paid subscribers, and what proportion of the cost will be inflation linked? In terms of overall cost, I'm asking.
Let's go to the slide where we have those functional P&L. So this particular slide can give you some idea how costs are associated, but things until FY20 were very different, and post FY22 things are very different. So let's not take FY21 and 22 as a benchmark. And if you compare FY20 versus FY24 now or FY23 now, it can give you the different cost structure that has been going into different segments. This particular slide.
No, so but in terms of total cost, if you can, in terms of total cost, what is what is actually growing in line with this the paying subscribers, and what will from here on, how do you see that cost structure in terms of fixed and variable?
We are looking at maintaining the margin and probably increasing the margin up to 30%. So I don't expect the margin to expand very rapidly or contract very rapidly. I just expect the margins to stabilize at this level, 28-30% or 30-32%, and then we'll see what are the levers further.
Okay. Okay, so thank you and all the best.
Thank you, Amit. Next question is from the line of Mr. Sarang Sanil from RW Investment Advisors. Hi, Sarang. Please go ahead with your question.
Hello, good evening, sir. Thank you for the opportunity. My first question is to Brijesh, sir. Then I'll come back to IndiaMart's business. So you said that Busy is planning to launch desktop cloud version, but I believe you already have a mobile app version which updates real time, and I believe it's through cloud. So why is it so hard to have a desktop cloud then?
See, when we have a mobile app which connects directly with the desktop application and the data is synced, the kind of activities that you're able to do in the mobile app today largely are related to viewing that data. In terms of entering transactions or vouchers, you have limited number of these vouchers that can be entered through the mobile app and sync the desktop. However, there are organizations who have multiple offices, or there are multiple people who are working remotely on the accounting system, and they need to have access to the same desktop software over a cloud machine. And therefore, Busy Online actually makes sense for those kinds of customers. And therefore, Busy Online, which is desktop available on cloud, is a product that services that particular segment where there is a need to access remotely at any point in time from anywhere.
Sure, sir. That was helpful, right? On the IndiaMart business side, so is it possible to give a split between metros and rurals? Is it possible to give a volume split and value split? It can be on an overall 208,000 also. And is it fair to assume that the metro side has better margins?
Metro side would have better margin because metros, as on 31st March, this number is given. So paid suppliers from metro cities were 54%, while tier 2 cities had about 28% and the rest of India 18%. And rest of India used to be 10-12% if I remember pre-COVID. We have now have a better tele presence and better channel presence. Now, in terms of value, we don't have a split here, but you can assume that 60% of the collections or revenue would come from metro cities, because metro cities would have a better and a deeper penetration of gold and platinum and a better ability to serve the customer. However, the tier or the rest of India, which is 18% in terms of the customer base, would only account for maybe 12% of the revenue.
Understood, sir. So just want to understand a little better here. So what is that factor that the paid suppliers are seeing to stick with IndiaMart, or the new suppliers coming at a higher, ARPU now, right? Because I can see, in the past couple of quarters, the traffic has been flat. So this is regarding on the buyers engagement side. Traffic has been flat, registered buyers, which is not material. So active buyers, which is material, that has been flat. Unique business inquiries, that has been flat. So what is that one factor you think you would pitch to a new paying supplier?
If we look at the active buyer base, that there has been a jump from a 30 million active buyer yearly to 37 million active buyer in the last 2 years. Last 2 years means FY20 to FY22. However, we did not increase any customer base in those 2 years. We ended FY20 at 1,47,000 and we ended December 22 at 1,55,000 or so. So this whole 7,000-8,000 additional active buyer has not been monetized, and also this 7,000-8,000 active buyers which has been increased, their nature has changed. So their nature in FY20 and 21 was mask and gas and sanitizer. Now those are gone. So there is not much of a mask selling, not much of a gas selling, or not oxygen selling, or not much of a. Now these are back to the usual business, the previous usual business. So while you see this is flat, actually there is a lot of transition has happened from the shortage-led demand to the broader industry demand. So that is also need to be fulfilled, and 37 million is huge actually if you see in a B2B kind of a scenario. If we can match them properly to a buyer, a right buyer to a right seller, I think there is even you could solve even double the number of sellers with the same buyer set. So the problem is not that people need more inquiries. People need more relevant inquiries where the maturity can happen better. So if you see, we continuously work on enriching the buyer profile and making sure that the right buyer goes to the right supplier. And by doing that, you actually do not need too many buyers to come back again and again on your platform. You actually get better maturity done. So there are two ways to do it. Either you start vertically with one small sector or one small industry. That's what we used to do in Tolexo. Or you start horizontal and then keep tweaking the buyer seller matchmaking better and better. And today even more possibilities are emerging, because earlier we could do that only on certain parameters. Parameters means defined parameters such as location, such as quantity, or such as product category. Now we can, with the advent of large language models in the artificial intelligence, we can actually do text analysis and do the matchmaking even better. So in times to come, you will see even further better deployment of machine learning algorithm using these large language models that have emerged to be able to do even specification level matchmaking, or even even the buyer profile level matchmaking. So I'm not worried even right now. Yes, if this continues to remain the situation for 2 years or so, then obviously the problem is very big.
Understood. So you're not worried about the on the buyer side. So my last question is, do you think generative AI or any of that application on that side would help in improving the margins on a medium to long term perspective?
So generative, not I don't think the generative would help, but a lot of predictive AI will help. And while the whole of the attention of the market is on the generative, in fact that whole large language model has a lot more impact on prediction, which was earlier very different, and now it is very different, because now unstructured data can do a much better prediction.
Got it, sir. Got it, sir. That was helpful. Thank you, and all the best.
Thank you very much. It has been a very engaging session. I would now like Dinesh to give his concluding remarks.
Thank you, Aditi. Thank you, ladies and gentlemen, for joining our Q1 FY2024 conference call. We have tried to address your queries in the time available, but if you still have any questions, please free to contact our investor relations team on the email ID given at the press release and the investor presentation. Thank you. Have a great extended and delayed holidays. Look forward to seeing you around Diwali.
Thank you, everyone. On behalf of IndiaMart, we now conclude this webinar. Thank you very much.